Hello everybody, Benga Olatunji here. We want to look at evaluation and review of audit work. So we are on advanced audit and assurance, and practically what we do in the field, evaluation and review. So what should we expect from this video? We will be dealing with going concern. What is going concern? Concern itself. So we will define what going concern is and management's responsibility as regards going concern of the organization. Then, what are auditors' responsibilities for going concern? We will look at it. Then, indicators or symptoms of going concern issues or problems in the organization of our clients. We will look at it. What can we perceive that can put us on inquiry as regards the going concern of the business? We will look at it. We will look at what audit procedure as auditors should we perform. Having known that there is a problem, what audit procedure should we carry out? We are going to look at it. Also, it's easier to observe issues and problems than to resolve it. And it's the person that actually resolve issues that has actually worked. So we are going to look at ways by which businesses, our clients, can overcome their going concern issues, because going concern matters will always arise. So how can we resolve them? How can we help them? How can we be of help in resolving going concern? Then, what are the types of audit opinion that we could express when we observe going concern issues or generally on audit works? What are the audit opinions that we should expect, that we should express? If you are just joining us, please go and subscribe right away as we go into the tutorial. James Associates, we are value to life, value to your businesses. Click the notification button, like us, comment, engage us. We'll always be available to reply to your comments or send us an email. So let us proceed to what to do and what to expect, one after the other. In reviewing our work and on the field, one of the things we must pay attention to as auditors are going concerns. So when we say going concern, what do we mean? We can define it as that a business should live for a foreseeable future time, that an organization should live on a perpetual basis. So when this is affected, then we say we have going concern, because when we incorporate a company, it's expected that it will definitely outlive the proprietors, the owners, the founders, depending on the name that we can give or we want to bear. And after that, it should live on perpetual basis. Don't forget, especially limited liability companies, the half-life of their own, different from the founders. So it is expected that every organization should live for indefinite future time. But when it's becoming definite and we can foresee that something may soon go wrong, we will say we have a going concern issue. So that is going concern. The assumption that the entity will continue in business for foreseeable future time. And when something is affecting that assumption, then we will say we have going concern issues at hand. What are management's responsibilities concerning the perpetuity of an organization? It is expected that management team coming from the board spiral down to management staff, managers, and the like. It is expected that they should run the organization in a way that it will be profitable enough to sustain itself. It will be profitable enough to expand. It will be profitable enough to make progress and conquer territory, and even to outlive the owners. But when they are not running it that way, we are going to have a going concern issue. But one of their primary responsibility is to ensure that they run the organization profitably. Of course, returns on investors' money or investments, which will come as a result of profitability too. So they must ensure they run the organization properly. Also, where they observe as management now, they observe that they are going concern issues, they should try as much as possible to come out in the open, especially to the auditors, that see, we are having challenges in these regards and it's a bit of a going concern. So it is their responsibility to be able to do that. Also, it is the responsibility of the management to prepare the financial statement. Every manager or the board of directors directly are responsible for the preparation of the financial statement of their organization. So these are some of their responsibilities. Let us look at now what are our responsibility as auditors. What are we responsible for when we are talking about evaluation and review of our work, and particularly going concern audit? It is our responsibility to obtain sufficient, appropriate audit evidence. It rests on us to ensure we obtain enough evidence, sufficient enough for us to have a good judgment of what has transpired within the year under review of our audit. It is our responsibility too to conclude whether a certain matter is material or not, and to clear every uncertainty that come to our knowledge in the course of our audit work. And last but not the least, we must report on it. It's our responsibility to ensure we report on our audit. So these are some of our critical responsibilities as auditor. So what are the indicators of going concerns? What are we going to observe as auditor that can make us to conclude that our client is having going concern issues? What are the symptoms that we can observe and know immediately that something is wrong somewhere concerning our client's business. We can break it down into financial concerns, operational concerns, and some other matters. Let us look at some financial indicators. If they are experiencing low liquidity ratio, cash is not available, they are cash pressed, is a concern. Also, if they are experiencing high gearing ratio, you will observe high gearing ratio having reviewed their financial statements. That is, they are actually borrowing more than they can easily repay. They are highly leveraged. They are highly geared. And there is almost little or nothing on ground substantive enough to say they can use in repayment. That is a going concern matter. Don't forget those places that they took money from. Money must return, and they must return with interest. So when we observe this, it's a going concern issue. Also, if they are heavily depending on short-term funds for long-term investments or long-term projects, we used to call it mismatch. Using short-term fund for long-term investments is a going concern issue. If they are having financing of long-term that is overdue to creditor, that is supposed to pay to creditors, but they weren't able to pay, is a going concern issue. It's a financial issue and it's a going concern issue. If they're supposed to pay dividends and they could not pay it, it's an issue. If they are defaulting in their loan agreement, it's an issue. All these and many more, if they are declining in their profitability, it's an issue. All these issues affect the going concern of organization, affect the longevity of an organization. And when we perceive this in their financial statements, excess borrowing and the like, they are having diminishing or bad relationship with their bankers and the like. Creditors are no longer happy with them. Different correspondence as regards this. When we observe all this, we know that our clients are not doing very well and the business may not continue to perpetuate. On operational matters, indicators that we may perceive if our clients begin to experience staff turnover, high staff turnover. Of course, we know people come, people will go. But if there is high turnover, especially high turnover of key management staff, is a big issue and it's a concern for the going concern of the business. Strike here and the like. Let's say it's an organization that is a bit large and they have workers union and workers are going on strike. It's a going concern issue. Something is wrong. Somebody is not satisfied. Somebody is disgruntled and workers must work. for the organization to make sales and profitability. So, as auditors, we must hold on all these as symptoms. Heavy dependence on the sources of a new product that we're supposed to grow so that it could be more profitable, so that it could become our cash cow in the nearest future, when the whole business now is depending on a new product that we just developed or just introduced to the market. It's an issue, and as auditors, when we see this and observe it, we should be put on inquiry. Excess reliance on suppliers is an operational issue. We should ask ourselves a question fundamentally as auditor. What of if something go wrong concerning the client, concerning the vendor, the supplier? That means even the business of our clients will not continue. So it's a going concern when they rely excessively on one supplier of their raw material. Let's say they have patent rights and the like, and they lose it to competitor or franchise, and they lose it is a big issue and pointing to going concern. Political risk, undue influence from competitor, marketer, and the like. These are operational matters that could affect and jeopardize the long-run performance of the organization. There are other points that we could raise that will fall under the purview of going concern, like changes in law generically as a country is going to spiral down and affect business operation. If there are pending litigation and we don't know whether our client is going to win or not, it's a going concern issue. So all these are symptoms of going concern matters that our clients may experience. And when we as auditors begin to observe this in our review and evaluation of our clients' business and financial statements, we should be put on inquiry as to the longevity of the business. For how long will they be able to weather the storm? Let us move on now to audit procedures. Having observed what is going on in our client's business, what must we do to dig deep into it? Don't forget, audit dwells on evidence. We must validate our suspicion. So, what are audit procedures that we must carry out? We know they are having, let's say for example, liquidity ratio is not what it's supposed to be. They are highly geared and the like. It will be good for us to analyze their cash flow and discuss it with the management. We need to analyze their cash flow. What is cash flow performance? Why are they not able to meet loan obligation as agreed with bankers, as agreed with creditors? Why is it that they could not pay dividend as a when due? We need to analyze their cash flow. We need to analyze the financial statements, the management account given unto us. We need to review the term of the debenture. You see that term is not that favorable from the onset. What is really going on? We need to analyze critical documents like that. like debenture agreement, loan agreement that they've entered into. Minutes of meeting is a very good evidence for us to obtain and read through. What are board discussions that they've had? What are critical issues that chairman is raising, that chief executive officer is raising, or are raised in the course of the year? We need to know what are their concerns as regards the business that they are managing, and minutes of the meetings will actually be of good help. So we need to obtain minutes of meeting. We need to make inquiries from the secretary of the company or the lawyer, especially when we had heard that they have pending litigation. So what is going on, how far, and what are the chances of winning or of losing? And if we win, what will be, and we lose, what will be in form of our cash flow, cash liability as regards the pending litigation. So we need to discuss with the litigation officer or the representative of our client, that is the lawyer, who may serve as the secretary or may not. But whoever it be, we need to know the person and relate with the person. We need to confirm existence, legality, and enforcement of arrangements to provide or maintain financial support with related third parties. We need to know, in fact, have a list of third party list, obtain it from the board. Obtain it from the board. Let the directors give us, and we know how to relate with the concerned parties and see whether a lot are happening, because transactions with them are not done at arm's length. So we need to confirm the existence and transactions that transpired between our clients and third parties, especially those ones that are related to third parties. Their financial ability, we need to assess it. Assessment of their financial ability, having gone through the cash flow, what are the possibilities they still have? Customers order, let's say sales, they were not able to meet up with sales. Why? We need to analyze. When we observe this, why? Customers are demanding, but we could not supply. Audit procedures must be carried out. It may be in form of inquiry, may be in form of circularization, but we need to carry it out that we've mentioned for us to establish whether the organization will still continue to be or not, because as auditors, it's part of our assignment to know whether the organization will continue or not in the foreseeable future time. Because it's not that good that after auditors come and go, the auditor could not raise any observation that relates to a dying organization. So we need to carry out all these audit procedures. We need to request and make some representation to management too. We usually call it management control reports or letter of weakness, to address our observations and what they can do to come out of the going concern matters we've observed. We're already going into the next phase of our topic, ways by which businesses can overcome going concern problems. So we need to use letter of weakness to address the management on what and what they could do. having carried out our audit procedure, having observed the symptoms. So, what are the ways that we can propose? Don't forget, in an MCR, that is Management Control Reports, as we are reviewing and relating to the management as per the observation in the course of our audit, we must let them know the implication must be documented or what we've observed, and we must show them the way out. And the way out is what we want to talk about. One, it's possible that they have some redundant assets. They may need to dispose it off so that they can pay creditors and have more of their goodwill back in the market, because these are the things that affect the goodwill. And when goodwill is affected, sales is, or revenue turnover is inevitable affected. So they may need to dispose assets that they hardly use. Maybe they purchase them because of the time they have more than enough, but they don't really need it. They may need to meet, we may need to propose to them to meet the bankers, the creditors, the suppliers, and renegotiate, reschedule their existing facilities. They may need to obtain this permission and discuss with their bank. They may have sister company, associates that could bail them out. So having gone through and having obtained the related third-party lists and the transactions, if we observe that they have associates around them that are a bit buoyant and could bail them out, we can propose that they have a discussion with the company or their representative to be of help in a time like this. They may need to lease rather than outright purchase. Don't forget that outright purchase will tie down capital. But when they lease as per their need and pay rent on it. So if they've been operating and having a lot of assets and purchases, they may need just to lease and sell off some assets to recover cash that they actually need, to postpone the replacement of assets. If they can lease it, then they can buy in foreseeable future time. These are some of the things that we may need to propose. They may need to research more of their environment so that information, trends will not be meeting them when the world has gone ahead. They will be abreast of the technology. They will keep pace with the competitor when it comes to technology. They will know what is in vogue in their industry. They may need to diversify. Maybe they just have one product line. They may need to develop products and introduce it into markets or introduce it to new markets, depending on the approach they want to use. They can take alternative courses of action in respect of resources. And alternative courses of action actually vary depending on the situation. Like the lease as against outright purchases. Also, it's possible that the issues observed relate directly maybe to humans, that is staff, management. So they may need to overhaul their recruitment processes and ensure they employ suitable candidates and persons. These are some of the way out that we may need to propose to our clients. So now let us look at the reports. What are the types of reports that we may need to give out or express? What are the opinions that we may need to express now as auditors? Basically, we have modified and unmodified opinion. Modified and unmodified opinion. Why under modified opinion we have adverse opinion and we have disclaimer opinion. Adverse opinion and disclaimer opinion. So what do we mean when we say unmodified opinion? Unmodified opinion actually is given when we had carried out evaluation and review, and we can assure ourselves that no going concern issues or material misstatements in the financial statement presented to us. So we give a clean slate, no issues, no matters of concern, no matter to emphasize in any paragraph. That is unmodified audit opinion. Now we can have modified audit opinion. So when we say we have modified opinion, we are talking of circumstances in which auditor has concluded that something is wrong with the financial statement, whether materially or due to constraint, and we are not able to carry out our work the way we had planned it to be. So these are some of the causes in which we could modify our opinion. So let us look now at types of modified opinion. We have adverse modified opinion and disclaimer modified opinion. So when we are talking about adverse opinion, we must have encountered scope limits. That is, there must be an aspect of our work in which we could not be aided, whether because of irresponsiveness of the management not being able to give us access to what we require to carry out that audit assignment or that segment of our audit work. So when we experience scope limits, especially from the management side, that is after we've requested we would like to obtain certain things, information or access to maybe people or location and the like, but we are not aided, then we can express adversely in this regards. We will issue a disclaimer rather, because when we issue an adverse, we must have observed a pervasive misstatement, pervasive error before we can issue an adverse opinion. So what do we mean by pervasive? So it's a situation in which we observe errors and we could not determine to what extent it has spread across the financial statement or it affected the financial statement. Let me give us an example. Let's say the opening balance, the audit journal for last year were not posted, and the previous auditor had moved on, and now we newly audited it, and we could not lay our hand on the audit journals raised, and the accountant did not post into the account. This is pervasive. It's going to affect everything that has been done in the course of the year, and we could not determine. We could not lay our hand on it. Accountant could not lay his or her hand on it, and prepared the account based on the hold trial balance, not on the final audited statement given. So we may issue an adverse opinion on a case like this. So the misrepresentation or the misstatement must be pervasive. The uncertainty must be of a magnitude that is material, and that we cannot really determine to what extent it could affect the financial statement. With this, we issue out an adverse opinion. So basically, we had covered what we expected. Let's quickly go over it one more time. We had defined what going concern is. That is, it is expected of every organization to live to perpetuity and outlive the founders. And when we begin to have or observe symptoms that the organization could collapse or could not go forward in the nearest future, we say we are having a going concern issue. The management responsibility has been discussed, and primarily they are to prepare the financial statement. They are to come out clean when encountering going concern issues. Come out clean to auditors, come out clean to the shareholders and every stakeholder that they need to attend to. Disclosure, they must disclose. And on our own part as auditors, we must obtain sufficient appropriate audit evidence. We must issue out a clean, crystal clear opinion that is not ambiguous. May need to issue out modified or unmodified reports, maybe disclaimer or adverse, but nevertheless it is our responsibility, having concluded an audit, to express our independent opinion. We had examined symptoms of going concern, that is what we can perceive that will tell us it's possible this organization is going through some challenges. Then it will point our attention to also on to how we should audit them, which we call audit procedures to perform. So symptoms could be financial, it could be operational, and some other elements could be along the way. So financial, it could be in form of liquidity. They are highly geared or highly leveraged. They were not able to meet their financial obligations to the bankers in form of loan facility, to suppliers in form of their purchases and the like. Dividends are already going in arrears, and they are having bad relationships with their bankers, with creditors, private shareholders and the like. So also on the operational side, they are losing key staff. Management staff are leaving, strikes here and there within the organization. Political issues are overtaking them. Loss of patents, rights, franchise, and critical success factors are being eroded. All these factors we had discussed. Audit procedures to follow or that we must perform to had been looked at. We talk about we must analyze their cash flow, relate with third party, circularize, and many more. And we must also propose way out to our clients, help them to get out of it in form of proposing that they may need to lease down, buy, they may need to dispose of some assets, they may need to embark on diversification rather than relying on one product line to generate income and many more. We've last but not the least spoken about audit report to be issued out. Basically, we have two types of audit reports. It's either it's modified or unmodified. When it's unmodified, it simply means we do not have issues with the financial statements and we express true and fair opinion that the financial statement is true and fair. Clean slate, no string attached. But when we have modified opinion, then we have a concern. And we said when we have modified opinion, it can be divided into two. It's either it's adverse or disclaimer, and we issue out disclaimer when we have scope limit, and we issue out adverse opinion when we observe or encounter pervasive misstatements in the financial statement. If you have enjoyed the video, don't forget to click subscription button, subscribe to us. TGM's Associates, we are value to life, we are value to business. Next time, still on audit and assurance, evaluation and review, we'll be looking at another topic under evaluation and review. Some of the topics that we need to look at are subsequent events, related parties transaction, and analytical review.